we're going to talk about Chapter 15, which is talking about stockholders' equity. So stockholders' equity, we're going to talk about all components of it. You can read through those. Reacquisition, dividend policy, presentation. So basically the two primary sources of equity are contributed capital, so what the owners pay in, and earned capital. So we all know that as retained earnings. So we're going to focus more on the contributed capital side of it, how are shares issued, etc. So hopefully you know the three forms of business, so I'm not going to spend any time on that. You can read up on it. Basically, in a corporation, though, it's a little more involved than just starting a partnership or a sole proprietorship. If I went out and sold anything to you right now, I would have a sole proprietorship. So if I decided to sell something out of my house online, it would be a sole proprietorship. However, for a corporation, it's a lot more involved. They have to submit articles of incorporation. The state then issues a charter. Know that a lot of corporations are formed in Delaware simply because the laws are simpler and favor corporations. But anyway, so the state laws vary some of these items, although overall they're pretty much the same. But when we get into par, there's some state law requirements that are different from state to state. Okay, so basically if you own stock in a company, these are the rights that you have. And those rights are basically to share proportionally in the profits or loss, which basically means if I own 1 share of stock and you own 1 share of stock, we get 50-50. But if I own 2 shares of stock and you get 1, the profits or losses go to per share. So I get 2/3, you get 1/3. I also get 2 votes because I have 2 shares of stock, where you get 1 vote as you have 1 share of stock. In the event of liquidation, we share proportionally the assets, but be careful on this one. So if you remember, assets equals liabilities plus owner's equity, the creditors get it first. So if we liquidate and if the creditors are paid and if there's more left over, then basically since I own 2 shares of stock and you own 1 share of stock, I would get twice as much as you. And then to share proportionally in any new issues of stock in the same class, this is called the preemptive right. Sometimes I think of the preemptive right as first dibs. So I get first dibs. So in other words, if I own 2 shares of stock and you own 1 share of stock, and so that's 3 shares of stock that are outstanding in the corporation. If the corporation issues 3 more shares of stock, I get first dibs on 2 of them. So in other words, I need to maintain my proportional ownership in the company. So let me make another example. If the company has 1,000 shares of stock and I own 10% of them, hold on. Okay, so if the corporation has 1,000 shares outstanding and I own 100 of the 1,000 shares, I have a 10% ownership. So if the corporation issues 200 more shares, you're going to see that the corporation has outstanding 1,200 shares. I get first dibs on 10% of them. So I get first dibs on 20 of them, and you can see now I own 120 shares, which is indeed still 10%. So that's the preemptive right. I get the first dibs on new shares in the same proportion to my ownership, so I can overall own 10% of the company. Okay, so this kind of gets back to what I said before. These creditors get it first, and the stockholders get it second. Sometimes there are different classes of stock, common and preferred, and we'll get to that later on in the chapter. But basically, the common stock is the last in line. So they're the residual corporate interest. Whatever gets left over, whatever is residual, whatever is left, goes to the common shareholders. So that's why they say they bear the ultimate risk of loss, because creditors get it first, then preferred shareholders, and then common shareholders get it last. However, on the upside of that, if you're liquidating and you had a great business, so let's say you're liquidating because you decided to retire, you decided to do something. The creditors get paid what is owed them. The preferred shareholders will get a specific amount that will be listed, and the common shareholders get the rest. So if the rest is a lot of money, then the rest is sometimes better. Next one, so notice these are the two primary sources, contributed capital and earned capital. So contributed capital is made up of common stock, preferred stock, and something called additional paid-in capital, which we'll talk about. And then earned capital is made up of retained earnings. There's something we'll call treasury stock, which is basically, notice that's a subtraction. So we'll talk about that later too. All right, so we're going to talk about each of these. So notice on this handout I said, make sure that you know the following: how to issue par stock, no par stock, stock issued with other securities, non-cash transactions, what you do with issuing costs, etc. So kind of make some notes and do that. They're not exactly hard, but you can, they're a little bit tricky at times. So par value, not all stock, a lot of stock has a par value. So you might say 1 share of $10 par value common stock. For accounting purposes and for valuation purposes, par value means almost nothing. Some state laws require that your market price can't go below par value. Other state laws may have some requirements on par value, but par value does affect our journal entries, but it doesn't necessarily mean a whole lot. So anything that we sell it for in excess of par value, that's why we call this additional paid-in capital, which you'll see in just a second. So here, I guess I do have this slide on there. Blue Diamond Corporation issued 300 shares of $10 par value common stock at $4,500. Prepare their journal entry. So notice what they got is cash. So that's 300 shares for, I'm sorry, it doesn't give the per share price, for a total of $4,500. You can only credit common stock for its par value. So its par value is 10. And later on, you're going to figure out that $10 does not mean a whole lot. Again, it might mean something in various states, but it doesn't really reflect the value of the stock itself. So it's $10 par common stock, so I can only credit common stock for $3,000. As a result, I need another account to account for the other $1,500. And we call that by various names, paid-in capital in excess of par, which basically means any paid-in capital. Remember, paid-in capital is what stock issued by the company. It's not retained earnings. So this one makes a lot of sense. So it's paid-in capital, but it's not the $10. It's anything above the $10. I generally call it additional paid-in capital and abbreviate it APIC, which you feel free to do that also. All right, no par stock. So basically there are sometimes no par common stock. It does avoid this contingent liability, a liability contingent upon, you go back to here, is that maybe you can't go below par, so you'll have a contingent liability based on if the market price goes below par, etc. But again, it's for us, it just simply means I have two accounts when I make a journal entry: common stock for par, additional paid-in capital for anything above par. And notice there are some states, so notice most of the times you have a problem with par changes, it's a state law, not necessarily an accounting issue. Okay, so no par stock, how does no par and stated value stock different? Well, no par stock, obviously, if I issue 500 shares at $10 a share and there's no par, all it is debit cash, credit common stock. If it had a par value, I would credit common stock for 10,000 shares times whatever its par value is. Issues 500 shares. So 500 shares times its par value, and then the rest would go into additional paid-in capital. This one has no par, so it all goes into common stock. If it has a stated value instead of a par value, a stated value is treated exactly the same as par value as far as accounting, except we don't call it par value, we call it stated value. So notice the same thing in this problem right here where we had $10 par value, and this one it's $5 stated value. The only thing that can go into common stock is its stated value or its par value. Here it's stated, so 1,000 times 5 is 5,000, and I got $15,000, 1,000 times 15. So the extra goes into paid-in capital in excess of stated value, or again, if you call it additional paid-in capital, APIC, that would kind of catch all both of them. So how does no par and stated value stock differ? It's very little difference. Stated value is treated the same way as par value, and no par, you simply wouldn't have paid-in capital. All right, so what happens if you issue stock with other securities? So let me pause this a second. Okay, so see there's two methods for doing it, the proportional method and the incremental method. I'm going to do this on Excel as soon as I pause this and show you, and then I'll show you the next PowerPoint. They show a lot of steps that I simply do on my calculator, and I'll kind of show them on Excel. So hold on while you pause for this commercial break. All right, if you remember how we record if we purchase land and buildings, so for instance, if we had land, can't spell, and if we had a building, and I can't type. So if we had land worth 100 and we had building worth $500, then the total amount is $600. Okay, but if I paid $550 for it, I know that I've got to debit land, and I know that I have to debit building, and I know I have to credit cash. And the cash is going to be the cash I paid, so I said it's $550. Okay, looks like it's going to be a little bit smaller over there. But anyway, I need to debit land and building. Well, if I debited land for 100 and building for 500, the thing wouldn't balance. So I know that I can't do that. Because 600 debits 550. So what I do is I just simply allocate it in a ratio. So I know this is 1/6 or 100 of the 600,000, and then I multiply it by what I paid for it. So this is going to get 1/6 of the purchase price, and this one's 500 of the 600,000 times my purchase price. So again, it's simply a ratio. So now I know I can see that 92 plus 458 is 550. What I'm going to do under the proportional method, I'm going to leave this down here because I'm going to show you the incremental method in just a second. But if you look at this, I issued 300 shares of $10 par value common stock. So I have 300 here. Par, again, it just only comes in the journal entry, so you can kind of underline it there. And 100 shares of $50, so I have 100 shares of preferred stock for a lump sum of $350,000. So in common stock, I issue common stock, so instead of paying cash, I'm getting cash. So I know that I'm getting cash of $13,500. All right? Okay. So now I need to know how much do I credit common stock for and how much do I credit preferred stock for. Okay, I do know that I can only credit common stock for the account itself for par, so I know that is 300 shares times over here $10 par, so $3,000, and so I know I'm going to have an additional paid-in capital common stock, and then I'm going to have preferred stock, and preferred stock is 100 shares times its par value, which was 50. Okay, so I have 5,000 there. Okay, and so I know that some of it's going to go to, if I have more than 5,000, some of it's going to go to additional paid-in capital. So notice right here, these two amounts are the ones that are going to be relative to common stock, and these two amounts right there are the ones that are going to be relative to preferred stock. So now the same thing that I do as I did over here, again, these are number of shares. It says the common stock has a market value of $20 per share. So my total is my 300 times 20. So my total market value of my common stock is $6,000, and my total market value of my preferred stock is $90 a share, and I had 100 of them, so 100 times 90. Okay, so 9,000. Do not simply use 90 and 20 because I've got a lot more common shares than I have preferred shares, so it's going to weight it more towards that. So I have a total of 15,000. I hate when it tries to think for me. So right now what I'm going to do for common stock, I'm going to actually put it over here because it's not going to be as direct as the one down here. I know that 6 of the 15,000 I need to allocate towards common stock. So 6/15 times the amount of cash I got is going to be allocated to the common stock, and 9/15 times the amount of cash I got is going to be allocated to the preferred stock. So notice additional paid-in capital is anything above paid-in capital. So I have 54, but I've already put 3,000 in common stock, so I need a total of 2,400 there, and I need a total of 3,100 there. So let's see if I add up to that. I should add up to 13,500, and yay, I do. So that is the proportional. So it's just like this one, except I have 2 accounts that account for common stock and 2 accounts that account for preferred stock, whereas in this one, I only have land and buildings, so I could do it. So I'll show you the PowerPoint, kind of how they did it. They write out. Okay, so here's their computation. Notice they do a percentage, so they say 6/15 is 40%. I don't, and then they take 40% to that. I just take 6/15 times the 13,500. So again, they get the 54 and the 81. And so what their journal entry looks like is just exactly like mine. I debit cash for 13.5. My common stock, theirs is down here, so they have common stock, additional paid-in capital. Their preferred stock, they listed it first, is 8,100. So again, just like mine. Okay, so now we're going to go to the incremental method. This is the correct way you would allocate an asset, being a bargain purchase and a fixed asset. This way that I'm going to do it in the incremental method is not allowed for fixed assets, but I just want to explain it. Under the incremental method, what you would do is you would give one fair market value toward one or the other, and then whatever's left goes to the other asset. So for instance, I know one is 100 and one is 500. I could care less that they total up to 600. What I do is I pick one. So I'm going to say I'm going to allocate the fair market value to the building because maybe I bought the property mainly for the building. So I have 500 to the building, and then incremental, whatever gets left goes to the land. So notice I have 500, I put 550, I put 500 to the land or to the building, the rest goes to land. Alternatively, I could do 100 to the land, which leaves, the incremental method leaves 450 to go to the building. So I have 550 and 550. This method is not allowed for fixed assets. You have to do the prior method, the proportional method. But it is allowed for fixed asset or for corporate capital. So what I need to do is I need to decide, all right, which one am I going to allocate first? And so in this case, it says under, if you go through the overheads, which I will in just a second, you're going to see under assuming the preferred stock, assuming the market value of the preferred stock is unknown under the incremental method. Okay, so actually I don't know this one. I'm going to delete that one. Okay. All right, so what happens is I'm going to give 6,000 to the common stock. So remember, I paid 13,500 for it. I don't know the value of the preferred, so I'm going to give 6,000 to the common. Common stock itself can only be credited for the par value, so 300 times 10 is 3,000. So the rest goes to additional paid-in capital. So I should put the right number there. So these two have to total $6,000. Okay. Sorry about this. Some of these have commas, some of them don't, and that drives me nuts. Okay, then what happens is the rest goes to preferred. So if I have 13,500 and 6,000 went to the common shares, then the remainder of it, which is 7,500, goes to preferred stock. So if preferred stock is par of, I about said help me out and none of you are here, 100 shares times par value of $50, so I have $5,000. So the rest of it, and I said that was $7,500, so the rest of it's that. So notice I add all these four up and it equals 13,500. Proportional method, I would have 9,000 there, I'd know it, and I'd say, okay, 6/15 and 9/15 under the incremental method. I simply give it 6,000 that I know to the common stock, so 6,000 split between par and the rest. And then the rest of it goes to the preferred stock. The rest of it is 7,500. So make sure you make those two journal entries. That's the proportional method. So the incremental method, this is kind of what I just did on the handout. See, we got 6,000 nothing. So I give 6,000 to common, and then the rest of 7,500 goes to preferred. So your journal entry looks exactly like I just did, but they have preferred stock first and I have common stock first. All right, so make sure you, look at that little note there. Make sure you write out to the side which one is the proportional method and which one is the incremental method. Okay, then the next thing is what happens if I don't get cash when I issue stock? What if I get land? What if I get a truck? What if I get something else in exchange for the stock? So look back at these journal entries that you just did up here and notice you debit cash and then you credit common stock and additional paid in capital, or preferred stock and additional paid in capital. In this one, the question is, what do I debit? Well, you debit whatever in the heck you get. And then if you remember back from a prior chapter where we exchanged assets, when you exchange land for cash, you always use the fair market value of whichever one is more clearly evident. And in the land for cash example, the fair market value of cash is certainly more clearly evident than the fair market value of the land or whatever you got for it. So if I have stock issued for land, the stock is more clearly evident. However, if I have a building for land, back in the prior chapter, it's kind of hard to determine which one is more clearly evident, land or building, so I have to be told. If you're in a real business, you would have to figure out, okay, which one is more readily determinable. So that's what all this is saying. In general, they should record stock issued for services or property other than cash at the fair value of the stock or the fair value of the other thing, whichever one is more clearly determinable. Okay, and so I'm going to go through some of these. I'm not going to go through all of them because they're kind of obvious. You just debit whatever in the heck you got instead of cash. Okay, it looks like this one is the one I have here. Arganda Company gets a patent, and the patent's worth $140,000. So what do? I debit patent instead of cash. Common stock can only be credited for par, so 10,000 shares times $10 par. The rest goes into additional paid in capital. So pause this if you want to write that down. Hopefully it's pretty clear. I'm going to go through the other ones. You can put some examples on there if you want, but if you get it, you get it. In this case, they got a patent worth $150,000, but they couldn't determine the fair value of the stock. So I put the patent on there for $150,000. Stock goes for the same thing. 10,000 shares, $10 par. The rest goes to additional paid in capital. Next one, they can't determine the fair value of the stock, but they have an independent consultant who valued the patent. So again, patent, stock for $100,000, $25,000 for excess. Then, what happens if they can value the stock instead of the patent? Well, I would write down $100,000 for the stock, then I would take the rest into paid in capital, and whatever it was that they added up to, I would record the patent. If I couldn't determine the fair market value of the patent. So not any different than I had for fixed assets. I'm going to go to the next slide and then I'm going to come back to this one. What do I do with direct costs incurred to sell stock, such as underwriting costs, accounting and legal fees, printing costs, etc.? They should be reported as a reduction in the amounts in accounting of paid-in capital. So I'm going to go back, okay, and I'm going to pretend, let me see if I can get this thing to work. I'm going to pretend that I paid cash, so I'm going to credit cash. I'm going to credit cash for my underwriter's fees, my accountant fees, and a whole lot of other fees that I had to pay for issuing this stock. So let's say it is $5,000. Okay? So now my question is, that's my credit, because I know the cash is my credit because I paid it, so it went down. It just doesn't look like a credit, but it is really in the credit column. So then my question is, what in the heck is my debit? And my debit is paid-in capital in excess of par. Okay, and then so I'm going to debit that. All right, so if you look at that, sometimes, let's pretend this line here. This one was cash. Really can do this well, can't I? Okay, if this one was, if they issued it for cash instead of a patent, this would have been my regular entry right here. And then this is when I paid my issuance costs. Notice in some problems, some people combine them. So they would have just, notice cash is credited for $5,000. So they would have simply put $120,000 here. And then this is debited, so they would have put $20,000 on this one, okay? I don't ever combine them because sometimes I forget what in the heck I'm doing as I'm going along. I usually make it this entry, then this entry, but again, your online homework may have you combine them, write them down separately or whatever you need to do. I'm actually going to kind of go through this one because it's kind of interesting. So what happens if a company issues common stock? So I'm going to credit common stock, credit additional paid-in capital, right back to here. Credit common stock, credit additional paid-in capital, and somebody's going to pay them later. So the question is, what's my debit? And so you might think accounts receivable, but I want you to read through what Enron did. So some of you may follow Enron in accounting. There might even be somebody in your class right now that's following Enron in auditing, I should say. So notice that this accounting issue surfaced in Enron's accounting. Starting in early 2000, they issued shares of its common stock for 4 special purpose entities in exchange for which it received a note receivable. Enron then debited notes receivable and credited stockholders' equity. So notice up here, so should they have debited accounts receivable and asset, or should it be somehow a contra owner's equity account because it's not yet owner's equity until they get the money? So they said that increased its asset and owner's equity. As a result of this, Enron overstated assets. So think about that if they actually never ever got the money, which is sometimes what Enron did. Overstated assets and stockholders' equity by $172 million in its 2000 audit, and $800 in 2001. A billion overstatement was 8.5% of their stockholders' equity at that time. So notice that you don't record the equity until you get cash, and a note doesn't count as cash. So basically, for the question of what do you debit when you're going to issue stock and they're going to pay you later, and the easiest way to answer that is you wait until later to record the entry. So anyway, that's kind of an interesting one. Overlook a simple rule type thing. Okay, the next one, 5 features. Write down the 5 features of preferred stock and explain to yourself. Why don't you not explain them to yourself? Why don't you explain them to yourself right there on that piece of paper? And so let's go through them. Here's the 5 features of preferred stock. Preference as to dividends. What that preference means is they get their dividends first before the common shareholders get them. Sometimes a preference is not something you prefer to have, because a preferred stock a lot of times has the amount of dividends they're going to get. So for instance, if I have preferred $1 stock, and I'm not talking about par now, I'm just talking about that's the dividend. The preferred shareholders will get a $1 dividend before the common shareholders get anything. Okay, that's the preference. They get it first. It doesn't mean they're going to get more, because they only may get their dollar and the common shareholders may get $50 each, but they get it first. This one, preference as to assets in the event of liquidation. First come the creditors, then come the preferred shareholders, and then come the common stock. So is it a preference? Well, it's only a preference, or I guess privilege. You're privileged if you have preferred stock. It's only a privilege if we can pay off the creditors. So if we can't pay the creditors, you're in first in line to get nothing before the common shareholders get nothing. These two are generally preferences all preferred stock have. These are not preferences that is common to preferred stock. Okay, so some preferred stock is convertible into common stock. Some preferred stock is callable at the option of the corporation. So notice this is a feature, not necessarily a preference. And this is often associated. I've seen these more so than all of these. However, this one's pretty common too. Non-voting. So a lot of times only the common shareholders can actually vote. So I might issue preferred stock if I want more capital, and I'll give them their dividend first and stuff, but I still want to run the corporation. So I issue preferred stock instead of common stock so I can still control the thing. So make sure you know those 5 features. These two are preferences, but again, they're not necessarily things you prefer to have. It's not really a great deal if you get a dividend first and it's less than the common shareholders get. And if you get first in assets upon liquidation and you're in bankruptcy, so you can't even pay the creditors what they want. And these are, non-voting is a very common preference, a great way to get more cash into the company without losing control. All right, so I really thought, how about more than 5? Okay, so we're going to have 5 over here, and then you're going to probably write them right down there in the middle, and now you're kind of wishing I hadn't said that so you'd have room. But we're going to also write down these other 5 here. Here's features of preferred stock. They're cumulative. Make sure you know what these are. Flip your paper over if you have your paper flipped over, or squeeze them into the side. Write them what they are. Write what they are on a another one. Notice I did have slide 30 and I proceeded to ignore it. Cumulative. Cumulative means the dividends accumulate. So if you recall, I said that preferred shareholders get $1 before common shareholders get anything. What happens if I don't pay dividends 1 year? If I don't pay dividends 1 year, do I have to make up that $1 the next year before I pay common? And the answer is I don't know. If they're cumulative, the answer is yes. If they're non-cumulative, the answer is no. Participating. So let's say that, let's go back to that $1. I give the preferred shareholders $1. Okay, and then a lot of times the rest goes to common if it's non-participating. So the rest goes to common. Okay, and so that's non-participating. Make sure you write it out. Participating, the preferred shareholders get $1, then the common shareholders will get some amount. Sometimes that's $1, sometimes the reason you got $1 because it was 10% of par, whatever kind of preferred stock it says it is. So the common would get 10% of par too. So it may be that they get the same amount. It may be they get a different amount, but the amount that they say is always stated. The amount that they get is always stated. And if it's participating, so let's say this is $2 to the common. Okay, so I give every preferred shareholder $1. I give every common shareholder $2. Then I have this pot of the rest of the money. Okay, if it's participating, the preferred shareholders share in this. And you're going to find out that how they share is not exactly 50-50 split, but we'll talk about that later. So non-participating, preferred get theirs first, common gets the rest. If it is cumulative and participating, preferred would get last year's $1 if you didn't pay it, and this year's $1, and the common would get the rest. If it's non-participating, if it's participating, preferred would get last year's $1. The common gets whatever in the heck they get, and then you share in the rest. Okay. One other thing that I want to talk about is the cumulative. If it accumulates, okay, that is called arrears. Okay, so dividends and arrears are dividends of past years on preferred stock that you haven't paid. So this year would have 1 year in arrears. If I couldn't pay either dollar, if I didn't pay $1 this year or $1 next year, and it's a cumulative, then I would have $2 of dividends and arrears. So remember that. I always remembered it by if you were behind in your dividends, they were in arrears. So that's how I remembered it. But anyway, you don't have to remember it like that. All right, next ones that we have, convertible. Convertible is you can convert them into common stock if you want, or some other security. Callable means, we already talked about that one. They can call it in, you can have to sell it back to them. And redeemable basically means you can redeem them for something else, okay? Sometimes convertible, you'll have convertible debt that's convertible into preferred stock, et cetera, et cetera. So redeemable, you can redeem them for other things. All right. Let's see if I can. Okay, so you can see, this is this one right down here. The journal entries for preferred stock are exactly the same as the journal entries for common stock, except you call it preferred and not common. So 10,000 shares, $10 par. They issued them for $12 cash, so the cash is 10,000 times $12, 120,000. Preferred stock can only be for par, 10,000 times 10, and the rest goes to paid-in capital. Okay, so now we're going to go into the reacquisition of shares, stock. That big name, that important big name right here. When you buy back your own stock, it is called, drum roll, treasury stock. So, write that down there. Oh, it said why. Boy, I can't read. All right, so it's called, when you buy back your own stock, it's called treasury stock. Write that out there. And so why do corporations buy back their own stock? Sometimes you don't want to pay them a dividend, but you want to get cash out to them. So you buy back your stock from your shareholders, and you can get them a capital gains dividend. Remember, earnings per share is net income divided by shares. So if you have lower number of shares, the earnings for everybody else goes up. And return on equity, I've reduced my shareholders' equity, so the return on equity goes up. Some people first see that and they think that is unethical to manipulate like that, but honestly it's not, because you're not forcing people to sell back their shares. You're offering a share price for it. So basically, if I brought a big cake to class, and the cake was this big, okay, if you wanted a bigger piece, I could say to some people, don't come to class, and if only 2 people came to class, there's your size of the cake. And if 4 people, there's your size of the cake, et cetera, et cetera. So how could I make these pieces bigger? Well, I could go backwards, and I could say, all right, let's not have as many people show up, and each one gets a bigger slice of the pie. So anyway, that's one thing that you do. Provide stock for employees' stock compensation, or to meet potential merger needs. So basically, sometimes you may have to issue stock and merger to the new company that's buying you out, but this is more common. So if you have a stock bonus plan, stock compensation contracts that I pay people a certain number of shares each year, the only way I can get that is buy that back in treasury stock. Sometimes I want to thwart takeover attempts. So if I own 50 shares of a company and you own 55 shares of a company, some outside person can take over the company if they can convince all of you to sell you their shares of stock. And they might by paying you double for it or whatever in the heck. So maybe I kind of hear about that, and before they do that, I try to get 3 shares. So note, if I get 3 of these shares, yours goes to 52 and mine goes to 53, and suddenly you can't do it because there's no way you can get more than 50% of the shares. So that's this one. And sometimes if we go back to economics, supply and demand, I simply make more kind of market in my stock by stimulating demand by buying it back myself. Okay. When you purchase treasury stock, there's 2 methods that you're going to do. So just like there was 2 methods to issue when you had common stock and preferred stock, when you issued them together, that you had that incremental and proportional method, you could have 2 methods for purchasing treasury stock. They're not related to those 2 methods, by the way. There's the cost method and the par stated value method. In all cases, treasury stock reduces stockholders' equity. So we'll get to that later, but you actually don't unissue stock. When you buy it back, you put it in treasury stock. So treasury stock is a negative. So let's go to this one. You got this right up here. So we have issued 100,000 shares of its $1 par common stock at a price of $10 per share. So my original entry was to debit cash for $1 million, credit common stock for par, credit additional paid-in capital for $900,000. So that's sitting right there. In addition, it has retained earnings of $300,000. So here's my stockholders' equity section. I've got common stock, additional paid-in capital, so I have total paid-in capital. Then I have earned capital of $300,000, so I have total stockholders' equity of $1.3 million. Okay, next one. All right, so we're going to have 3 things that can happen here. We're going to sell the gotta buy them first. Okay. They acquire the 10,000 shares of treasury stock at $11 a share, and it now sells. Actually, let me pause this a second. Okay, now I'm on the right page. There's our issuing thing. On January 20th, they acquired 10,000 shares at $11 a share. So this is the cost method. Make sure you write that over here. This is the cost method. Okay? What I mean by the cost method is I recorded at what it cost us, not at the $1 par value method. Okay, so if I acquired 10,000 at $11, I have 10,000, $11, 110,000, and I credit cash. Okay? Now what I want you to do is I want you to keep track of treasury stock. So notice I have 110,000 here, and I want you to write over to the side what that is. So I'm not going to do it because I can't write this, but write 10,000 at $11. Because if you buy some more in there, you might put another 5,000 at $12 and another 6,000 at $13. You need to keep track of what they are. So write this right beside there. Okay, so I know that they came in at $11 a share. The reason is you have to take them out for the same price you put them in there for, and I put them in there for $11. So I better take them out at $11. So the next one then, where I was before, what happens if I sell them for above cost or below cost? And so remember, I bought them at $11 a share. Okay. All right, so I can either sell them out for above $11 a share or below $11 a share. That's my concern here. Okay, so let's say that so why did you record it this way and not use the $1? Well, because I used the cost method. how many shares and what is the price for each. So remember, I've got 10,000 shares at $11 a share, which is important, and make a T account of the treasury stock. And I've done that. That was my T account I kind of drew over here of the 10,000 shares at $11 each. Okay, so now we're, I think I've got my slide number wrong. So they acquired, it now sells 1,000 shares at $15 per share. So notice this $15 is more than the $11. So they're going to record it as follows. I got cash, 1,000 at 15 is 15,000. Put up a little parentheses right here behind your treasury stock. 1,000 shares at $11. Now go to that T account that you had that I drew in there. And I had 111,000 or 110,000. Okay. And I had 10,000 at 11. Hopefully your handwriting's better. Okay, so now what I did is I got rid of 1,000 at 11. I don't even have to do that, but I got rid of 1,000 over here, so this one is the 11,000. So now I have 9,000 at 11. Okay, over there, and so 110,000 minus 11,000 will give you 99,000 left. So keep a running total of what you have, because you might be buying more at a different price. Okay, and so treasury stock comes out of treasury stock for what I put it in there for. Cash is debited, and the rest goes to additional paid-in capital treasury stock. So notice I differentiate where my paid-in capital comes from, whether it's preferred stock, common stock, etc. Okay, so now I'm going to, that's above cost, so now I'm going to go to the below cost one. So now they sell it below cost, so we'll write down here. They sell it at $8 a share. Same thing, I get it out of treasury stock for what I put it in there for. I also need to draw another T account. Okay, and so if I go back to the previous slide, I had 4,000 here. Okay. Now what I have is I get it out of treasury stock for what I put it in there for. So I take another 11,000 out here. So now I had 99,000 in it. So now I have 88,000 down there that's left. Okay, and so then I'll have 8,000 shares at $11 left. So keep track of that. And as long as I have a credit balance in here, I cannot debit it for more than I have in it. So right here, I can debit additional paid-in capital treasury stock. I can't debit it for more than 4,000. So I need to make this T account of $3,000 in there. So now notice I have $1,000 left in paid-in capital of treasury stock. Make sure you make those T accounts, okay? So here's your T accounts that you're recording it. You're going to do a better job than I have. 11,000 or 110,000 minus 11,000 minus 11,000 gives you 88,000 left. And your paid-in capital from treasury stock, I had 4,000 in there. Took out 3,000 in this entry, and I have 1,000. So now I'm going to go to the next one. Okay, and assume Kripe sells an additional 1,000 shares at $8 a share on April 10th. So notice it's the same thing as this one, $8 a share, but this is pretty different. Okay, so notice I debit cash for 8,000. I'm going to clear this thing out in just a second. I credit treasury stock for what I put it in there for, which is $11 a share. However, I've only got $1,000 left in my paid-in capital. So I can't make this into a debit balance account. So I'm going to clear that thing. Okay, so notice my paid-in capital treasury stock gets debited for the $1,000. It now has a balance of 0, and I don't balance because I got 9,000 over here and 11,000 here. It's got to come from an owner's equity account, and the owner's equity account it comes from is retained earnings. And you're going to find that happens a lot in this situation. When you run out of a place to put it, it goes to retained earnings. So why did you do that? Why you did that? I was going to say, why did you did that? Explain to yourself why you did that, okay? The reason I did that is because I cannot have a paid-in capital account with a debit balance. A paid-in capital account's an owner's equity account, and owner's equity accounts always have a credit balance, and so in this case, I can't make it debit. I shouldn't say always, because treasury stock itself has that. But anyway, I cannot have paid-in capital of any of these things as a negative balance. Once I wipe it out to zero, I take it to retained earnings. And this will not be the only time you do that. Okay. Next one. What is retiring stock? Now, you might have asked yourself, when I bought treasury stock, why didn't I just undo the journal entry for when I sold it? And that is because I intended to use it. Remember back in an early slide when I said when we sold treasury stock, we had to pay an underwriter's fee, lawyer's fee, accountant fees, etc., etc. So it's really expensive to issue stock. So if I am intending on buying it back to give it to shareholders or to possibly do something with in the future, I want to sell it, and I want to sell it quickly at a cheap price. So I keep it in treasury stock. However, if you are going to never use it again, that's retiring. And so what do I do with it when I retire treasury stock? I simply reverse the issue of when I had it, and we'd have a reduction in the number of shares of issued stock. So I'll take it out of treasury stock. Remember, treasury stock has a debit. So I'll take it out of treasury stock with a credit, and I'll take it out of common stock with a debit. So I'm going to, in this case, debit common stock, okay, and I'm going to credit treasury stock. The normal balance in treasury stock is a debit, so when I credit it, I get rid of it, and the normal balance in common stock is a credit, so when I debit it, I get rid of it. If these two transaction amounts don't equal, because remember, treasury stock is put in there for $11, so if it's 1, that's 11, but common stock might have a par value of 10. Like everything else, you're going to have probably first additional paid-in capital. Notice this is going to be a debit here. So if you have additional paid-in capital from treasury stock, you'll take it out of there. If not, then I'll have retained earnings. All right. That. Okay, so the next section we're going to talk about dividends, but since I'm kind of tired of this a little bit, I'm going to stop here, and plus this is 52 minutes. Look at that. That's how long it's recorded, and I've paused this thing, so I've been here a little longer than that. So I'm going to put this on a separate video. So I will see you later. Stay tuned in for next week's exciting episode of Stockholders' Equity.